Good day everyone. We are pleased to present our thesis entitled Impact of Capital Structure on Financial Performance of Publicly Listed Property Firms in the Philippines, 2014 to 2024. The research was conducted by Marlyn Anjanette S. Casurra, Justine M. the Guzman, and Piolo M. Fajanilan. Together, we have conducted this study to provide insights into financial strategies, capital structure decisions, and their effects on key financial performance. In the Philippines, publicly listed property firms have recently faced increasing financial pressure. According to Delmendo, 2025, residential property prices experienced their biggest decline in nearly a decade due to weaker demand and reduced investor confidence. The Guzman, 2023, also reported a rise in non-performing loans in the real estate sector, driven by higher operating costs and elevated interest rates, which negatively affected profitability indicators such as return on assets and return on equity. Moreover, Ong, 2025, and Jackson, 2025, highlighted that elevated borrowing costs, oversupply, and stricter bank lending increased financial vulnerability among property firms. Remalona, 2024, further noted that high vacancy rates and declining demand, including reduced activity from Philippine offshore gaming operators, weakened overall market conditions. These industry reports highlight the growing risks faced by property firms and emphasize the need to reassess capital structure decisions. Therefore, this study examines the impact of capital structure on the financial performance of publicly listed property firms in the Philippines from 2014 to 2024. This study is significant to various stakeholders, including investors, business owners, real estate firms, and academic institutions. By examining the relationship between capital structure and financial performance, the research provides practical insights on how firms can optimize their debt-to-equity mix to improve profitability and increase shareholder value. For investors, the findings serve as a guide in making informed investment decisions. The study helps identify property firms with balanced capital structures that demonstrate stronger financial stability and potential for higher returns. For financial managers and business owners, the results offer guidance in determining the most appropriate combination of debt and equity in financing operations. This supports better cost management, improved operational efficiency, and maximized profitability. Lastly, the study contributes to the academic community by addressing existing research gaps and serving as a reference for future studies. It also enriches learning materials related to capital structure management, helping students, researchers, and educators better understand real-world financial practices in the property sector. Result of the study: the debt-to-asset ratio was used to measure the extent to which publicly listed property firms finance their assets through debt. On average, the firms recorded a debt level of 40.33%, indicating that about 40% of total assets were funded by borrowed capital. While this average remained relatively stable throughout the study period, leverage peaked in 2020 at 0.428, reflecting increased borrowing during heightened economic uncertainty. The standard deviation of 0.217 shows wide variation in financing behavior, with some firms using very low debt of 1.3%, while others were almost entirely debt-financed at 95.2%. Several firms experienced notable declines in leverage due to equity financing and internal funding. Arthaland Corporation recorded a significant drop in 2016 following a preferred shares offering, which reduced reliance on debt. Araneta Properties Incorporated and SOC Resources Incorporated also showed sharp decreases in their D/A ratios after funding projects through equity and internally generated capital, reflecting conservative capital structures and lower financial risk. Philippine Estate Corporation similarly exhibited a major decline in 2021 after a stock rights offering, indicating post-expansion deleveraging. In contrast, spikes in the D/A ratio were primarily driven by debt-funded expansion activities. Arthaland's leverage rose in 2020 due to green bond issuance, while Ayala Land Logistics Holdings Corporation, Robinson's Land Corporation, and 8,990 Holdings Incorporated recorded higher leverage during periods of land acquisition and construction finance through loans and bonds. These increases indicate strategic use of debt to support growth rather than financial distress. Overall, the results confirm that movements in the debt-to-asset ratio directly reflect firms' capital structure decisions, where declines are associated with equity injections and asset growth, while spikes occur during deliberate debt finance expansion phases. Earnings per share (EPS) was used to measure the profitability of publicly listed property firms by showing how much profit was generated per outstanding common share. Over the study period, the firms recorded an overall mean EPS of 0.3943, indicating an average profit of about 39 centavos per share. However, the high standard deviation of 1.1040 reveals extreme volatility in earnings, reflecting inconsistent profitability and varying risk levels across firms. From 2014 to 2016, EPS values were generally modest and stable, indicating steady project completion and regular profit recognition. Earnings improved in 2017 and 2018, with EPS rising alongside stronger market conditions and increased project turnovers. The sector reached its strongest pre-pandemic performance in 2019, when earnings peaked as demand remained strong. This upward trend was disrupted in 2020, as the pandemic caused construction delays and weaker sales, resulting in lower mean EPS and more firms posting losses. A gradual recovery followed in 2021 and 2022, as operations resumed and earnings stabilized. The most significant fluctuations occurred in 2023, which showed the widest EPS dispersion in the entire period. EPS ranged from a low of -12.010 to a high of 11.191, reflecting the impact of firm-specific extraordinary events. The sharp decline was driven by Philippine Infradev Holdings Incorporated, which recorded substantial losses due to write-downs following the Supreme Court ruling affecting the Makati Subway project. In contrast, Keppel Philippines Properties Incorporated posted the highest EPS after recording large one-time gains from its divestment in the Podium project. These results demonstrate that EPS is highly sensitive to extraordinary gains and losses, and while the sector remained generally profitable, firm-level performance varied significantly. Return on equity (ROE) was used to assess how efficiently publicly listed property firms generated profits from shareholders' equity. From 2014 to 2016, ROE remained relatively stable, with small positive averages and low variation, indicating steady demand and comparable profitability across firms. Differences in performance began to widen in 2017 and 2018, as some companies experienced lower project turnover, rising costs, and delays, leading to greater dispersion in ROE values. Across the entire 10-year period, the sector posted an overall mean ROE of 2.7%, suggesting that firms generated modest returns for shareholders. However, the high standard deviation of 0.688 indicates extreme volatility relative to the low average, reflecting inconsistent financial performance and elevated risk within the sector. The most significant movement occurred in 2019, when the minimum ROE dropped sharply to -12.383, the lowest value in the dataset. This extreme negative spike suggests that at least one firm incurred substantial losses, write-downs, or equity adjustments, which pulled the sector's average into negative territory for that year. Following this decline, ROE gradually improved in 2020 and 2021 as construction activities resumed and firms recognized income from delayed projects. By 2022 and 2023, ROE levels became more stable, with smaller gaps between firms and more consistent profitability across the sector. A notable contributor to ROE volatility was Evergetesco Resources and Holdings Incorporated, whose severe losses, asset write-downs, and capital restructuring significantly reduced shareholders' equity, resulting in sharply negative ROE. Overall, the results show that ROE is highly sensitive to earnings fluctuations, leverage, and equity restructuring, explaining the sharp drops during periods of financial distress and the stabilization observed during recovery phases. Return on assets, ROA, measures how efficiently property firms use total assets to generate profits. Across the 10-year period, the sector showed a modest average ROA of 3.4%, reflecting the capital-intensive nature of the industry, with a standard deviation of 0.078, indicating moderate variability. From 2014 to 2016, ROA remained stable, with narrow ranges and low dispersion, showing consistent asset utilization. Volatility increased in 2017 and 2018, driven by firms like Evergatesco Resources, which recorded significant credit losses and impairments, lowering net income without reducing asset values. The most severe decline occurred in 2019, when mean ROA dropped to 0.010 and the minimum fell to -0.592, reflecting large write-downs, unproductive assets, and project delays. Recovery began in 2020, strengthened in 2021 with a peak mean of 0.058, largely due to one-time income recognition and reversals of prior allowances, especially from Evergatesco. In 2022 and 2023, mean ROA moderated to 0.046 and 0.037, respectively, but firm-level divergence remained high. Extreme spikes in 2023 were observed, with Keppel Philippines Properties posting exceptional gains from asset divestments, while Philippine Infradev Holdings recorded significant impairments, causing sharp declines. Overall, ROA movements show that profitability in the Philippine property sector is highly sensitive to extraordinary events, asset impairments, and capital structure decisions, rather than uniform operational performance. Effect of capital structure on financial performance in terms of earnings per share. Effect of capital structure on financial performance in terms of return on equity. Effect of capital structure on financial performance in terms of return on asset. Recommendations. 1. Property firms may review their financial strategies to keep earnings steady, which can help maintain the trust of investors and shareholders. Companies may look into improving how they manage their assets so that their overall returns remain healthy and consistent. 2. Firms may consider keeping their debt-to-asset ratio at a manageable level to avoid financial strain that could affect future investment decisions. The amount of debt finance in the financial mix of the firms should be at the optimal level. 3. Property firms are encouraged to carefully manage their debt levels to improve asset utilization efficiency, as capital structure significantly affects return on assets, while maintaining balanced financing strategies to avoid unnecessary risk to earnings per share and return on equity. 4. Future researchers may extend this study to other industries to determine whether the relationships capital structure and financial performance are consistent across different sectors, and identify additional financial ratios that may influence profitability. This concludes our presentation on impact of capital structure on financial performance of publicly listed property firms in the Philippines, 2014 to 2024. We hope that our study has provided valuable insights into how capital structure decisions influence profitability, asset efficiency, and shareholder returns, and how firms can optimize their financial strategies for long-term growth. Thank you for your time and attention.